All right, y'all. So welcome back to another episode of Motion and Success. Listen, guys, my name is Cody Brown, and I got my co-host with me today.
It's Ayo, and yeah, we back with another great episode, bro. Y'all already know we bring really knowledgeable experts in the field, especially when it comes to entrepreneurship. This one's gonna be crazy, y'all, because we got Michel. Money making it. Yep. So he gonna teach y'all the tax strategies y'all need to know to really save money in 2025. So this is one that y'all don't want to miss.
Absolutely. So listen, guys, if you're looking to go ahead and get started in the Airbnb game, this is going to be the episode that you need to stay to at the end. Listen, if you're a business owner, if you're an entrepreneur, everybody knows one of the most important things is saving money on taxes. Because now when you're making money, you also got to remember somebody else got to take their cut as well. And that's unfortunately the IRS. But if you stay tuned in this episode, you'll definitely learn some strategies on how you'll be able to save some money on taxes. So listen, guys, let's go ahead and get started with the episode.
Oh man, Michel Valbrun, aka Money Making Mitch, certified public accountant, tax strategist, award-winning author, and yeah, tax strategist helping entrepreneurs, business owners, people with money, people who are just even without the money being able to understand how to win the game of taxes.
Okay, what was the book that you wrote?
So I got a couple of books I got a Prolific Profit, How Successful Businesses Maximize Profits and Dominate the Market, inspired by the late and great Nipsey Hussle. And I also got 10 Tax Commandments as well. So it's another book I wrote, helping entrepreneurs understand, the game of taxes.
Okay. All right, cool. So you can get started, bro.
Yeah, so I definitely want to get into backstories, because I know, especially jumping into the field of entrepreneurship, that's not an easy decision to make. Because especially if you don't come from an entrepreneurship background. So definitely want to know, like, how did y'all jump into that field of becoming entrepreneurs or even becoming a CPA? Like, what got y'all into wanting to chase after those things?
For me, I knew I always wanted to be an entrepreneur. I knew I always wanted to be successful. My parents actually came from Haiti to the United States to give my family and I the opportunity to be able to live the American dream. And through that experience, I had some interesting things that happened. So when I was 7 years old, I'm waiting for my mom to get home, right? And I'm a mama's boy. I'm gonna be real, all right? So I'm a mama's boy. So I see my mom pulling up at the house. I start running to the door. I'm super excited to see her. And as she's opening up the door, I see like this look of shock on her face. Like, I don't know what's about to happen. And I'm looking at her, and then I look to the right side of her, and she has like a gun pointed at her head, just like this. I'm just like, what? And I see this man. I've never seen this man before. I don't know if he's about to kill my mom in front of me. I didn't know if he was about to try to kill me. Next thing I know, I hear this guy say, which means tell the boy to get on the floor in Creole. Mom repeats it back to me in English. She says, Misha, he says, get on the floor. And I'm scared, like I'm on the balls of my feet. I don't know what's about to happen. I lay down. More people start coming in with guns. They start pulling out my sisters. My uncle was visiting from Haiti. My grandmother all laid on the floor. And they start searching the house. And they end up running out with a shoebox full of money. So come to find out, there's a shoebox full of money because my dad, he didn't want to pay taxes. All right, so he was doing what's called tax evasion. So he ended up getting arrested because of that. He got kicked out the country because of that. It taught me a really valuable lesson. I realized that people were willing to lie, steal, and shield to be able to get money. I was like, hey, whenever I figure out this money thing, I want to make sure I do so legally and ethically, right, and figure out the right way to do it. So that's kind of been my whole stance of really inspire me to like find the right ways to be able to get it and then also give it back to the people. So
that's crazy.
Yeah.
Because especially in our community, a lot of people don't know that legal tax holes exist, to save money. But I still see the shoebox money till today.
Right.
Still happening, you know what I mean? So it's crazy to see that people are still doing it, but I mean, that's why we got you here, man. So
right. And that's why, and the reason why is like there's so much confusion about the tax code. And if you look at it, like the tax code is like over 74,000 pages. So if you print out the whole tax code, it's like the size of a 2-story building. But what they don't tell you is that 95% of the tax code is actually showing you how to be able to legally and ethically avoid paying taxes. Only 5% is actually showing you what you got to pay taxes on. Everything else is telling you what to be able to do to be able to avoid it. So oftentimes, people tend to focus on the lack, but you really need to focus on abundance, right? And focusing on that side of the tax code. And society tells us there's 2 different tax systems. You probably heard of this, right? There's one for the poor, one for the rich, one for the poor, one for the wealthy. But the way I see it is like there is 2 different tax systems, but there's one for the informed and one for the ignorant. If you could be informed about the tax code, then you could be able to win the game of taxes. And the tax code is really an incentive. It's like a blueprint, literally, to be able to build wealth. You know what I'm saying? So like it actually shows you if you do the things that's going to make you wealthy, you could actually be able to save more money on taxes, like getting into entrepreneurship, being an investor. So all those different things. I can go, I can talk about it. I go crazy on this, but yeah.
Nah, that's what's up. That's what's up. And I definitely got to shout out the Zoes because I mean y'all really stick together. Like I'm hearing both of y'all backstory. I mean, it's a lot of Haitians out here in New York, and I see the same thing. Like y'all all support each other, y'all stick together.
We understand how to find the property, using AirDNA and B&B Calc. So now, when it comes to like a city and state, as far as like a tax-friendly state, if you wanted to find your first property in city, what's some of the states that are tax-friendly for a business owner and an investor? Would you say?
Really depends, because if we're trying to just off the top, if we're talking about like states that don't have any state tax, you got places like Florida, you got places like Texas, which is really popular. A lot of people moving to Texas, Alaska, Wyoming, New Hampshire, you got Tennessee. That gives you some tax benefits as well. So it really depends on, I wouldn't want you to just pick a state just based on saving state taxes, because what the states also do is they find other ways to be able to tax you, right? So for instance, they may try to increase the sales tax. They might try to increase the property tax. So I would say from a tax perspective, if your goal is to try to make more money, which I believe it should be if you're going to get into short-term rentals or Airbnb, then you want to look at what's going to be the best market for that Airbnb, what's going to be able to produce the most traffic. But some of those bigger states that I mentioned, like the Texas, the Florida, are always going to be hot spots because there's always something going on in those locations. And Nevada is another one as well.
Okay. All right, cool. And then like when it comes to like, starting up the Airbnb, because people are more than likely gonna start incurring like costs, buying furniture, things of that nature. What's some of the ways that people like what's some of the strategy that people are probably missing out on every single time when it comes to starting up a new business or even their first Airbnb property?
Yeah, for sure. So when it comes to those different expenses, so when it comes to the tax code, going back to the tax code, so the tax code favors entrepreneurs and business owners. Yeah. And the reason why is because the government, they create an incentive system. So, and they understand that as a business owner, for every person that you hire, you're employing people. So every person that you hire, that's one less person that has to go on unemployment. For any person that you put into a property, if you are an investor in real estate, that's one less person that has to be in public housing. For every dollar that you put into the stock market, that's one less dollar that the government has to put into the stock market and put into business. So you're helping the government do what they need to do, right? So that's number one. But even if you're a W-2 employee, you could still be able to have a business on the side. So a lot of people feel like when they think about business, they think about corporations, they think about the Facebooks and the Walmarts, but really by the definition when it comes to the IRS, as far as business is concerned, essentially needs to be in the pursuit of profit, meaning that you're trying to make money, you are working towards having money. So even if you're not profitable yet, you could still be able to start that business. And for a lot of people, there's things that you're already doing on the side. So whatever your 9 to 5 is willing to pay you, you could be able to get paid on that with your 5 to 9. So because generally speaking, if someone's going to pay you 100,000, you're probably worth at least $1 million, at least 10x. And that's what's going to open you up to being able to start writing things off on taxes. So when it comes to being able to write off things on taxes, the IRS actually has 4 requirements. Okay, so I call these tax-free. So if you want to find a way to remember, it's based off section 162 of the tax code. So tax-free, I say tax-free is the way to be. So FREE. So the first part of that, it needs to be considered for your trade, business, or profession. So we already talked about that. You got to have a business in order to be able to do it. Okay, and I'll say this, another thing too, a lot of people miss out on is that when they work with different people, they tell them, hey, my business did not make any money. And they feel like because their business didn't make any money and revenue yet, they don't file their business taxes.
How important is that though? Like
$10, $20, $100,000. Like it costs you a lot of money. One, because you want to be reporting all your income and all your expenses. That's number one. That's a requirement. But then number two is, let's say you made $10 in your business, right? But let's say you have $1,000 worth of expenses. I'm just keeping it really simple. So $0, $1,000 worth of expenses. Okay. So now that business, 0 minus 1,000, that's a $1,000 loss. All right, so now that $1,000 loss can then be applied to your W-2 income. It can be applied to your other income. So now it reduces your taxable income. So let's say with $1,000, let's say your tax rate is 30%. In that situation, that's like $300 that you're just pretty much throwing away because you're not claiming those losses and you're not claiming those deductions on your taxes. And people don't even realize. I literally talked to a client the other day and she said, yeah, my CPA told me I didn't make any money, so I don't need to file my business tax. I'm like, you're crazy. That's crazy. Yeah. I was like, yeah, someone has to go. Someone has to go. So yeah, that's the first part, the free, FREE. So we're on F. So it has to be for your business. The next thing is R. It needs to be considered regular for your business. The IRS calls that ordinary. So what's ordinary for your business is going to be different depending on the type of business that you're in, right? So one of my good friends, she owns an ice cream shop. So she could write off ice cream cones and napkins, refrigerators, spoons, all these different things. That's not ordinary for a CPA, right? That's not ordinary for an accounting business. So it needs to make sense for your business. So it has to be considered ordinary. The IRS calls that ordinary. The next thing is it needs to be considered essential for your business. So the IRS calls that necessary. So what's going to be necessary in order for you to operate your business is going to be rent, hiring employees, software, investing in legal professional services, education is going to be essential for you to be able to grow and scale your business. And then last but not least, economical. The IRS calls that not lavish or extravagant under the circumstances. So what does that mean? So depending on how much money you're making is going to allow you, it's going to pretty much determine what you could write off for real, right? So for instance, in 2020, 50 Cent, right? We all know 50 Cent, multi-millionaire. 50 Cent had a big tax bill at the end of the year. So what did he do? He bought like 6 G-Wagons, right? In 2020, he's like, yo, I'm going to just go ahead because back in 2020, you could write off 100% of the vehicle if it weighs over 6,000 pounds, right? So he's able to get a tax write-off. So maybe you might not be a multimillionaire yet. Maybe you might not be able to write off that many vehicles yet, but you could still be able to write off the different vehicle expenses that you have. I'll talk more about that. Or like Grant Cardone, right? A big real estate mogul, same thing, right? At the end of the year, he ended up having a big tax bill, and back in 2020, he wrote off a private jet. Right? Because he was able to show that he was using it for business purposes. He did it at the end of the year. So he had to, before the year was over, he actually had to fly the jet for business purposes to be able to show that it's being used for business. So, but as an entrepreneur, maybe you're just starting off, you can write off business travel. So that's another way. But getting into specifically for like Airbnb and short-term rentals and real estate, there's different things you can write off. So number one, the biggest thing when it comes to real estate is depreciation. All right, so depreciation is probably one of the best deductions because it's what's considered like a cashless deduction, meaning that you don't have to take money out of your pocket. When it comes to property, let's say you get a property that is worth $500,000, right? And it's a residential property. So you're able to get a tax deduction for that write-off based on what's called depreciation. So the government says, hey, it's raining on the property. It's going to have wear and tear. It's going to do all these different things. It's going to decrease in value. So if it's a residential, you're able to write off 27.5. You're able to write off that property over 27.5 years, right? Which comes out to like $18,000 per year, about $18,000 per year as a deduction that you take, even if it's not coming out your pocket. So let's say you have that property, right, and you're generating revenue. Let's say you make 18,000. Let's say you make 18,000 during the year. You have that depreciation deduction. Now you're able to have tax-free income because you're making money on paper. It's coming into your bank, but then you're also taking the deduction with it with the depreciation, right? And then there's another thing called cost segregation, which allows you, which is crazy, right? It allows you to be able to write off even more of that, right? So you could write off, if you do what's called a cost segregation study, where someone actually goes into the building and they look at the different furniture and the lightings and the fixtures, and they're able to write off even more in that first year. You could write off like 50,000, 100,000, just depending on that analysis, but that gives you an even bigger deduction. And that's how like a lot of wealthy people are able to pretty much pay no money in taxes because they're using that. So that's like the biggest thing. So I want to put that out there. But then getting to some other things you could do is, I talked about the vehicle, right? So there's different ways you could be able to write off vehicles. So there's the actual method and there's the standard mileage method. So the actual method allows you to be able to write off the actual expenses. So the first thing is, let's say you're leasing a vehicle. Like a lot of entrepreneurs lease vehicles is because with the lease payments, you're able to write off the actual lease payment based on the business use. So if you have a lease payment of $2,000 and you're using the vehicle at least 50% for business, so let's say you use it 50% for business, that $2,000 is now a $1,000 deduction that you're able to take off on your business, and you get a $1,000 tax write-off for something that you're already paying for, right? A lot of people already have vehicles, and that's one way to do it. Then with the actual method, let's say you're financing that vehicle, so you're able to go ahead and write off. You're able to write off things like your gas, your maintenance, the car washes, titles, registration, all these different things to maintain that vehicle, and you're using it for business purposes, then you're going to be able to write those things off. And the IRS actually allows you, if it's over 6,000 pounds, it used to let you write off 100%. Each year it keeps decreasing by like 20%. So that's one of the things I tell people is like the sooner you understand how to save money on taxes, the more money you could be able to save, right? Because now it used to be 100%, now it's down to 40%. Right. So that's one of the things like you have to be able to move with like a sense of speed and urgency. So vehicle is going to be a huge thing as well. And then when it comes to actual business use of that vehicle, so let's say you're going ahead and looking at your units, that's going to be considered a business miles. If you are also getting supplies, maybe going to the Home Depot, maybe going to IKEA, going to these different places, then that's going to be a business miles as well. If you're going to a conference, a seminar, that's going to be a business mile as well. So you want to make sure you're documenting that. I recommend people use Mile IQ. It's going to be a good app to track your miles. Mile IQ.
That's for
track your business miles, to track your miles in general.
Oh, for driving.
For driving. So when you start driving, it automatically is gonna pop. It's gonna start recording the miles, and then you let it know. You swipe left, swipe right to let it know whether it's for business or whether it's for personal. So that's gonna be able to track it. Or you can use QuickBooks as well. QuickBooks has an app, and you're able to go ahead and track your miles that way. So that's gonna be with mileage. So that was the actual method, but then you also have the standard mileage method, which the IRS lets you write off 70 cents. So let's say you drive 10,000 miles for business during the year. That's going to be like a $7,000 tax write-off for you. So that's going to be vehicles, and then getting into like supplies and equipment. So if you're going to furnish your unit, you're going to get the toilet paper, you're going to get the towels, you're going to get the furniture, artwork, the TV. All these different things are going to be tax write-offs that you could be able to use now with the Airbnb. Another thing with that is also traveling as well. So business travel is huge. What a lot of people don't realize is like, and these are things that you're already spending money on. That's the crazy thing. Like, so for instance, like a lot of people, like people love to travel, right? People are always doing travel. So what I recommend and what I tell people is that you want to find some way to be able to do something business related. So let's say you wanted to go ahead and go to Orlando, right? You want to take the family out to Disney World. You guys want to see Mickey Mouse and be able to go to Disney World. One of the things you can do is be able to, if you do something business related on that Friday and be able to do something business related on Monday, then you're able to write off that trip and it counts as a business travel. So this is the way to do it. So one thing that you want to do is you want to go ahead, you can maybe go on like eventbrite.com, you want to maybe go on meetup.com, you want to do research in that city, see what's going on that Friday. If you could do at least 4 hours of work on that Friday, then that's going to be considered a business day. You guys do what you need to do on the weekend.
Does it have to be 4 hours?
They want you to document it for 4 hours, and you have to you want to at least have the 4 hours to count as a full business day, because the purpose of that trip needs to be for business. If you just happen to go to Disney World on the weekend, then so be it. But you want to make sure it's for business purposes. So it does need to be, you want to at least show at least 4 hours that you're spending there, and then something on Monday. So maybe you're looking at more properties, more units to be able to invest in. Maybe you're meeting with your CPA. Maybe you're meeting with a real estate agent to find more properties and units to be able to do something.
What about company retreats? Does those count?
1,000%, yes. And how you thinking? Yeah. So if you go ahead and do a company retreat as well. So yeah, if you want to go ahead. So one thing I do, right, is every single year I have a mastermind. That mastermind just happens to fall on my birthday, right? It just happens to fall around my birthday, but it's a legitimate mastermind event that I host every year. It's open to the public. We sit down, we mastermind. I bring in big guest speakers. We all meet, we mastermind. We go ahead and typically we do it in the mansion. So we get the mansion, we get the decor, all those different things, and I'm feeding the people. So all those different things are going to be tax write-offs. So yes, like a company retreat, a mastermind, maybe you can have like a board meeting, for instance, where instead of just going on a family trip, maybe you guys are traveling. If your family members are in your business, which I recommend you can do that. If your family members are in your business, you could do what's called a board of directors meeting once a year. You all sit down, you guys plan, you guys go ahead and work on your numbers for the future, and that's another way for you to be able to do it. So the thing I tell people is, like, the tax code is law. So in order to change your tax, you need to change the facts. You need to change the facts of the situation and show that it's for business purposes. So those are going to be a couple of ways. And then the big thing when it comes to any business, which a lot of people don't talk about, is education. So education is huge too, but a lot of people don't realize that not all education can be written off. So they tell us to go to school, get good grades, go to college, right? But college tuition, you can't write that off. You can't write off college tuition. You can write off the student loan interest, but they cap that. But when you're investing, when you go ahead and get education as it relates to your business, then that becomes a tax write-off.
So what if you're in a scenario where you're a business owner and you're spending money on like you go to college and you become a business major, that won't consider?
Nah, bro.
Oh, wow. Okay.
Now, there's tax credits out there. There's like the American Opportunity Tax Credit, Lifetime Learning Tax Credits, but it's still not going to be as much as if, like, for instance, like we invested in Mastermind for $155,000, but we're able to write that off, one, because it's for our business, it's helping us be able to grow in our business. Plus, like I mentioned too, the amount of money that we're making in our business is not considered lavish or extravagant. So that's what we're able to do. But yeah, for college, no, they're not going to let you. You can write off the student loan interest, but they cap that off at like $1,500. So they limit how much you can write off. So that's the thing. Like I said, when the tax code, like I said, the tax code favors entrepreneurs and business owners, which is crazy, right? For people who are going to college, they're telling us to do this, but they don't really give you the tax benefits and incentives because, again, it just shows you what the government believes in. They believe that entrepreneurs and investors and business owners are going to be able to make the most money.
I wanted to get back into the taxes, because you was giving a lot of game right there. So I want to know your opinion on how do you feel about, Donald Trump? Do you feel like he's doing something illegal, or do you feel like he's just smarter than the average person when it comes to taxes?
Yeah, I would say in order for you to win a game of taxes, you have to have the right team for yourself and your family to win at the highest level. And it's a game. You know what I'm saying? And it's just like any kind of game. If you're trying to play spades, if you're trying to play basketball, if you're trying to play anything, right, you're not going to be able to win the game if you don't know how to play the game. So he just knows how to play the game at a high level. And yeah, what he does is it's within the tax code. So one of the things that helps him the most, or one of the things that really helps him, is that he fits that criteria, right? He is a business owner. He does have real estate, right? I talked about the cost segregation and what you could do with that, even going on the Airbnb side, right? When it comes to rental income, there's the Augusta strategy. I could break all that down, but those are different things that you could do. But then another thing that he did that his team was able to find out is that one of his ex-wives, she passed away. So what he did, he buried her at one of his golf courses. You already know where I'm going with this. He buried her at one of his golf courses. Now it qualifies because it's in New Jersey. It qualifies as a cemetery. He's not paying property taxes, state taxes. He's not paying sales tax. It's gone, right? It's a tax loophole, right? But because he has the right people on his team to figure that out and be able to have that foresight, that's what he did, right? And he's when it comes to being a business person, he's probably one of the coldest. I'm not saying in a good way, but he's just like, it's no emotions behind it, right? It's just like, yo, how can I go ahead and pay the least of money as possible on taxes? So he does those different things to be able to save money on taxes. Another thing with the real estate is the 1031 exchange, right? So 1031 exchange, what allows you to do, that's if you're selling the property, right? So let's say you go ahead and buy a property and then you sell the property. Guess what you have to pay? You have to pay capital gains tax. Capital gains tax, right? That could be 20%. If you have a gain of $100,000, that's $20,000 in taxes that you got to pay, right? That's too much tax. All right. So what do the wealthy do? They go ahead and do what's called a 1031 exchange, where they go ahead and sell the property and they reinvest that income into another property that is similar, like what's called like a like kind exchange, and they go ahead and reinvest it into that property, and now they're able to defer the tax. So the taxes doesn't go away. They defer it, but guess what? They defer, and then they die. And they pass it on.
How many times can you defer the taxes when you're doing 1031 exchange?
As long as you want.
So like year after year until
you can keep deferring it. Yeah. Until you go ahead and don't do the 1031 exchange. And the reason why, you got to think about it, like, they want you to invest in property, right? So let's say you go ahead and start off with like a single family home. You have a gain on that home. Now you go ahead and get a duplex or a fourplex. Then you go ahead and get a commercial property, right? So they want you to, it helps you be able to, they basically want to incentivize people to be able to go ahead and invest into real estate, because again, it's going to be able to help the government be able to do what they need to do. And then even going to when it comes to the Augusta rule, you know, one of the strategies is like the Augusta strategy, right? Which is basically, it's based off of Augusta, Georgia. And in Georgia, they have the Masters Golf Tournament. So one of the things that you're able to do is you're able to rent out a space for up to 14 years during the year and not have to pay taxes on it. That one guest, let's say hypothetically speaking, that was the only guest you had for the year, right? They used the property for 12 days, right? You could do up to 14 days out of the year. They used his property for 12 days during the year. Mm-hmm. He gets $3,000. That's $36,000. 12 times 3, $36,000 of tax-free income.
Wait, so hold on. So a crazy question just came to mind. So now, let's say, for example, you're regular family owner, I said family owner, regular family, you have your homeowner as well. You got, let's say 2 units in the house, right? One of the units you live in, another unit you actually rent out for Airbnb or short-term rental. Are you able to benefit off the Augusta rule when it comes to having the Airbnb units and having guests coming in and save on taxes? Is that a method?
1,000%. Yeah.
And how much can like a person save, like if they didn't know this kind of rule? Like,
so
how much can you save on something like that?
You do it for up to 14 times out of the year. Yeah. And let's say, for instance, you do it for, let's say maybe you charge $2,000 per day. So just to give you an example, like $2,000 per day for someone to rent out that unit. That could be $28,000 for the year, tax free. Yeah, if it's under the 14 days.
Yeah.
And then, you don't have to pay taxes on. Now, if it's over the 14 days, that's when it kicks in. So if you're down on day 15, all of it's taxable. But if you're within 14 days or less, then it's tax free.
Have you ever seen somebody get like audited before?
I've seen people get audited, but not necessarily for that strategy. But what can get you audited is documentation. So documentation is key. Like, you got to make sure the document's on point. So, and this is what a lot of people don't talk about. When it comes to the Augusta rule, you do have to have the right documentation in place. So essentially what you're saying when you're doing that kind of strategy is you're saying that you want to think about it like a separate type of transaction. So either, let's say for instance, you want to do it for your business, okay? Yeah. So instead of you going out and renting a space like on Peerspace or going on VRBO or Airbnb to be able to rent out that space, then you're doing it for yourself, right? And in that kind of situation, let's say you were to do it on a Peerspace or Airbnb, it'll be a separate transaction. So you're gonna have an agreement. So you want to have an agreement. You want to make sure that you have a reasonable rate. So you can't just say, hey, a day rate for me is $10,000, right? It needs to make sense for where you live at. So you want to look at other comparable units. Maybe it's Peerspace, maybe it's Airbnb, VRBO, whatever the different platforms, to be able to see what the comparables are. You want to have that documented. So you want to have a lease agreement between you, the homeowner, and the business owner. So there has to be some kind of transaction in place. The money has to come from one account to another account. So It needs to come from the business account to the personal account. So that needs to be recorded and documented. So there's different things that you need to make sure that you're documenting to show that it's actually legitimately for business. So a legitimate reason could be having a board of director meetings, right? And you don't have to necessarily have 5-10 people. It could just be me, myself, and I, right? And you're going ahead and documenting that, right? You could do that up to 14 times during the year. Maybe if you're just starting out, maybe you could do it once a year, maybe you could do it once a quarter. So you don't have to use all the 14 days, but then that's how you want to make sure you're doing this. Documentation is going to be key in order to do it.
All right, so now I know this is a question right here that I feel like it might crush a lot of people's feelings, because like one of the things that I see a lot of times is people go out and they just start a whole bunch of different LLCs. You know what I mean?
Yeah.
Because they're thinking like, all right, cool, you'll be able to save money on taxes. Like, but what's the real deal behind it? Is it like starting an LLC? Is it starting a corporation? Like, and do you need multiple LLCs, when it comes to saving money on taxes as a business owner?
Yeah.
Like, what's the real deal?
Yeah, so the real deal is this. So when it comes to it, So we talked about the requirement to be a business. You have to be in the pursuit of profit. So you don't even need an LLC and an EIN to be able to be considered a business. Yeah.
So you can operate as a sole prop. And
Sole proprietorship.
Operating this business.
Yeah. I don't recommend doing that. Yeah, I'm not recommending doing that, but I'm also saying it because I know there's people out there scared to write things off because they don't have an LLC or EIN yet.
Right.
You know what I'm saying? But you could actually be a sole prop, do it under your social security number. Terrible idea, because then people could find out where you live and get your personal information. So you want to keep that separation. But when it comes to it, this is another thing that a lot of people don't realize. Even people who are in the tax profession don't even understand this concept of legal entity versus tax entity. So you have a legal entity that's going to define your legal protection that you have. So you have a sole proprietorship, doesn't give you any legal protection. You have an LLC, limited liability company, which means it limits your liability. So if someone trying to come sue your business, if you make sure you are maintaining what's called the corporate veil, making sure that your business and personal separated, you have separate business bank accounts, there's no commingling of the funds is what they say, and having the right documentation in place, they can't come after your personal assets like your house, your car, your all these different things, as long as you maintain that. So that's the LLC. That's the benefit of having the LLC. Then you have a partnership, right? That's when you're in business with more than one person. And then you have a corporation, right? And that's going to be another legal entity, right? And similar to the LLC where it gives you that protection. Then you have what's called a tax entity. That's actually how you're going to be taxed. So you got a sole proprietorship. You could be taxed as a sole proprietorship, a partnership, an S corp, and a C corp, right? But this is the thing with if you're just a sole proprietorship, you're paying what's called self-employment tax, which is 15.3%. All right. So basically, like, let's say you work a 9 to 5, you and your employer are paying that tax, right? So you're paying Social Security, Medicare. So you're paying as an employee 7.65%. Your employer is paying 7.65%. But now as a business owner, you are both the employee and the employer. So now you're paying 15.3%, all right? Which is okay if you're starting off, but once you start making a lot more money, so I generally recommend you want to consider at least at 40,000, really 50,000 is going to be that sweet spot when you really want to consider switching over to what's called an S corporation, because that's what's going to save you on that self-employment tax. So to give you an example, let's say you make $100,000 in your business and that's the profit. You pay 15.3% of that. That's 15,300. Instead, what you can do is you can go ahead and get that, switch over to an S corporation. Then you're going to have to be considered, then you're going to have to pay yourself a salary, right? So let's say you do 50% on the salary. Now, instead of paying 15.3, now you're paying like $7,000 on taxes, right? So that's like literally $7,000 savings just by switching over from a sole proprietorship to an S corporation, right? So in order to do that, there's different tax forms you have to go ahead and fill out. You got form 2553 to go ahead and file that. You want to do that within the first 75 days of the year, so March 15th, or you could do what's called a late S election. If you work with someone, they can go ahead and help you be able to qualify if you happen to miss that deadline. So that's another way to do it. And then when you become an S corporation, then you want to pay yourself a salary, and then you want to also, you're going to have to fill out a different tax form called 1120S. That's the key. But going back to that question, no, you don't have to create multiple LLCs. The reason why you should have a different LLCs is the LLC, remember, it doesn't help you save money on taxes. It just gives you that protection. So you're going to protect yourself from different kind of risks. So let's say you have two different types of businesses. So let's say I have an accounting firm. Let's say I have Airbnb, right? I need to have a separate LLC for those two to minimize my risk in each of those businesses. So both those businesses have different risks, right? In the Airbnb, someone could slip and fall, try to come after me. In the tax business, they could try to say malpractice or whatever the case, whatever the different risks could be in that category. So you want to have it separate. I know some people do it for business funding and stuff like that, but from a tax perspective, it's not really doesn't do anything for tax, but from a legal perspective, that's the reason why you want to have different LLCs or corporation. But corporation is a little bit more. I wouldn't recommend a corporation generally unless you want to have investors. Like if you think about Shark Tank, for instance, you want to have investors in your business, or you're doing like maybe $3 million in profit, then it might benefit you because it does have a flat tax rate on there. But yeah, that's gonna be how it works.
That's a lot of game. Right now, it's all over social media. You see people talking about write-offs.
Yeah,
like, all over. Is it that easy to write things off? Like, for example, let's say I'm getting married, but I'm a wedding planner. Like, I plan weddings, and I decide to post my wedding online and use it as marketing for my business. Could I write off my whole wedding?
Yeah. So I would say generally probably not. So you might be, if you're creative enough and you have enough documents to really show that it meets those 4 requirements. It's for your business. It's regular for people to do that in your industry. It's essential for you to do that, necessary, and it's not lavish or extravagant. So yeah, that to me, I think that's a little bit of a gray area. I would probably say generally no on that. A way that you can possibly do it is like, if you wanted to, you can be able to, some people, what they do for their weddings is they get like flowers, and you could actually donate those flowers to like a nonprofit, and that allows you to be able to get a tax write-off for that. So little things like that, you might be able to kind of finesse and try to do it, but really you want to make sure, like, the biggest thing is, like, there's a saying in the tax code is like, pigs get fat and hogs get slaughtered, right? So you can't go, you don't want to go too crazy, because then that's what's going to open you up for audits, right? It's going to open up your audit risk, especially if you're just a sole proprietorship and an LLC putting on a Schedule C, because that's honestly the tax return that they're really looking at. But if now you switch over to an S corporation, right, that actually reduces your audit risk by like 50%, right? It reduces it significantly, just because that shows it's more of a legitimate business. But yeah, you want to, I always say that you want to just make sure it makes sense. And if you could defend it, at the end of the day, you just have to feel comfortable being able to defend it and really showing, hey, it's for your business, trade, or profession. But generally things that are usually more personal, like things that only benefit you, maybe like a haircut, for instance, makeup, those kind of things, or clothing, right? If it's just like, if you're just going out buying clothing without like your logos on it and marketing purposes, then that's going to be harder to be able to argue for. Right. But so, you could, you know what I'm saying, you could shoot your shot, but you want to make sure you have the documentation to really.
So you said that you have to benefit from it somehow, right?
And it has to benefit the business. Brafi, I know. I get what you're saying. If you get a wedding and you put it and you market it, yeah.
Now so, I got another example though. So let's say nowadays everybody has different communities and things like that. Like even some people that have communities on OnlyFans, but they're teaching game, like it's real game on there. Could somebody write off my whole OnlyFans subscription? And if I'm learning marketing from
yes. So if you're getting the OnlyFans and that's crazy, that's crazy. But no, yes, if you get an OnlyFans and you're subscribed to an OnlyFans contributor that is contributing, providing educational information that's going to help your business, then go ahead and write off the OnlyFans. Go ahead and write off the OF.
What's the dumbest thing that you've seen somebody write off?
The dumbest thing, damn, there's so many different, people just try to write off everything. I think probably the most common that I get is really just trying to write off clothing. That's not, like I said, the IRS really is against that. One really, it's kind of crazy, but it was legit. There was a real estate agent who was selling property in Miami, and she was able to write off her yacht because she does luxury real estate, and because her clients need to be able to see the properties from the ocean, right? Because they want oceanfront property. Then she's able to go ahead and actually be able to show that it's for the business, it's regular for a business, it's essential for her to be able to sell the property, because they're not going to buy it if they can't see how it looks like on the water, and it's not lavish or extravagant because she's a multimillionaire real estate agent. So those are kind of things that you could be able to write off. Again, you just have to meet the requirements. And then going back to that Grant Cardone example, he wrote off that jet, and he actually got a tax refund that year because the tax write-off was so big. So yeah.
Nah, that's game. I'm glad you broke it down, because now I kind of see it a little bit more clearly, because you go online and everybody's like, this is easy. Like,
write it off.
Writing off chains, writing off designer clothing.
It's one of those things where they're not going to stop you. You could try to write it off, but then you also got to deal with that audit too, right, on the back end, and just have to make sure that you could explain it. So like I said, I take more of the approach definitely you want to make sure that you are, there's, like I said, 95% of tax code showing you how to save money on taxes. So you could pay your kids through the business. That's another thing, right? You could pay them up to $15,000 in 2025 up to the standard deduction. And, if if they're doing work in your business, you could literally be able to pay them and take it as a tax deduction and not have to pay taxes on it. So, and generally speaking, like you want to start them off like at 7 is generally like a good age because that's based off a court case. Some people try to do it younger. Not saying it's impossible, but generally speaking, the older it is, the easier it's going to be for you to be able to defend it. But yeah, there's that's usually how it goes. But like I said, things like at least you're already spending money on the vehicles, even the home as well. So if you're a business owner, you work from home, you got what's called the home office deduction that used to be considered an audit risk. It's not an audit risk because especially after COVID, most people are working from their homes, so you could be able to write off a percentage of your home. So let's say, you know, with all the allowable expenses that you have, your mortgage interest, your property taxes, your utilities, let's say you have a space within your home for business purposes, like 10% of those expenses can now be taken off as a tax deduction, right? You got the meals, right? So being able to write off meals, if you're having a conversation with someone, you're discussing businesses, or you're meeting someone to be able to look at units for Airbnbs, that's going to be a tax write-off, right? So it's just a matter of like being proactive. I think it's being proactive versus reactive, because there's two different tax seasons. There's tax paying season and there's tax planning season, right? A lot of people during tax season are trying to write off things and trying to figure things out. It's too late. It's too late. It's based off of what happened last year, so you just got to be proactive.
It's a lot of games just dropping on this one episode, and I'm pretty sure, like, we probably like an hour in now, bro. How much time we been in so far? Yeah, it's a lot of game. It's definitely been a lot of game. I just got a few. Like, I got one more tax question. So how would you like for college students? Like, how would you advise them to set themselves up so they don't become that? They don't just become a taxpayer, but they're actually saving on taxes, like saving money on taxes.
Yeah, that's a great question. So it's really educating them and letting them know that, again, the tax code favors business owners and entrepreneurs. So generally speaking, if you're going to go to college and you're going to school, you're probably going to work a 9 to 5, you're going to get a W-2. But what they don't tell you is that when it comes to that, let's say, for instance, you can make $200,000 at your W-2 job, and the average person is going to pay like $42,000 in federal income taxes. If you get into real estate and make $40,000 a month, you could pay 0 taxes, because that's the way the tax code is, right? So it's not anything to be upset about, but just understanding. And I would let them know that, hey, number one, you want to at least get into business. And honestly, this is probably the greatest time to get into business, right? It's never been easier to be able to get into business. Like, we can literally take our phones now and start a business, right? You could create a podcast, you can go on social media, like, and there's even more. Like, a lot of people are talking about what's going on in the world. Think about this, 80% of the money supply was created in the last 5 years. So like, all this money was created and generated. So it's the best time. So I would encourage them to get into real estate. I would encourage them to invest and educate themselves, understanding that the different tax strategies that are out there when you go ahead and start getting into becoming a business owner, investor, entrepreneurship. Because not only is it going to save you money on taxes, honestly, tax is just one thing, but it's also being able to help you build wealth, right? Being able to do these things, because now you have no ceiling when it comes to that. But let's say there's someone who's like completely 100%. I want to talk to the people who are like 100% anti-business, entrepreneurship, if they're scared. You could, if you're just a W-2 employee, you want to understand that being able to utilize things like maxing out your retirement. So when you work, when you go ahead and get your job, there is what's called like a 401k. You can go ahead and contribute to that 401k, and it's going to give you a tax deduction during the year. You can go ahead and if you become a homeowner, then they're going to give you some different tax breaks on that. So you can be able to write off your mortgage interest. You're able to write off your property taxes. You're able to write off different things as well. And those are going to be like some of the main ways. And then obviously taking advantage of what's called itemized deductions. So, making sure that you're recording if you qualify for it. It's becoming harder to qualify for it because they increased the rate. But if you go ahead and you could write off things like medical expenses up to a certain percentage, you could be able to write off like the interest, like I mentioned, taxes that you paid during the year, charitable contributions as well can help you save money on taxes. And you got like casualty losses that happen, but that's more of like unfortunate type of situation. So I would just tell them, the biggest thing, honestly, the cheat code is just find someone who is at where you're at and like invest in them, pay whatever they charge, and that's like the cheat code. Like that's like if I were to do it over again, I would like as quickly as possible try to find a mentor, try to find someone that's doing what I want to do and invest in them and use that as the pathway. And it doesn't have to take you 4-6 years like college does, right? It's just literally it's out there. So I would just say those are things I would let them know.
This is really a good one. And before we close up, I think you did mention in the beginning you wanted to say like the 10 commandments of what.
Yeah, I got the 10 tax commandments. So I want to wrap up here with you all. Rap, R-A-P. So growing up, I used to want to be a rapper too. So I came up with the song called the 10 Tax Commandments, inspired by Biggie's 10 Crack Commandments. So if you're listening, that's the beat. So check this out. I've been in the game for years. It made me an animal. There's rules to this code. I wrote me a manual, a step-by-step blueprint for you to get your game off track, the feds off your back. Rule number uno, let the IRS know how much dough you hold, because you know evasion breeds penalties, especially if that prep messed up. Watch your tax go up. Number 2, document expenses you could prove. Don't you know them boys treat lying like violence? Take it from your highness. I done see mad cats and chips cut for their schemes and tricks. Number 3, go form an LLC. A lawyer set that up. Properly draft up. Deed and the state up. Yep, for them big bucks. To get that paperwork clean up. Word up. Number 4, I know you heard this before. Always rely on your CPA guy. Number 5, never tax prep where you rest at. I don't care if they do it free, tell them leave. Number 6, that tax advance credit, debit. They think they're doing you a favor, no, forget it. 7, this rule is so underrated. Keep your personal and business completely separated. Business and blood don't mix like politics with no tricks. Find your business serious risk. Number 8, know the date your taxes due. If you miss the deadline, they'll be coming for you. Number 9 should have been number 1 to me. If you start a business, let's say wait for hobbies. If they think it's a hobby, they ain't trying to listen. You'll be stressing in the kitchen when them letters start hitting. Number 10, a strong word corporation, strictly for bizmen, not for freshmen. If you ain't got the taxes, then say hell no, because they ain't gonna want your money, rain, sleet, hell, snow. Yo, follow these rules. You have mad bread to break up. If not, 24 years on the wake up. Flow hit your tempo, watch your friends shake up. Caretaker, did you make up when you pass? My bad, I hope you rake up a lot of cash with beachfront in Jamaica with the Michelin star. Chef the hooker steak up. Gotta go. More returns to make up. A word up, Tax King.
That's a mic drop.
Appreciate y'all.
That definitely is a mic drop, and that was giving some Biggie too.
Yeah,
I did
you know
hear
what
it
I'm
in there.
saying?
I definitely did hear it in there. But nah, this was a really good one. Just tell them what y'all got going on.
Hit me up Instagram as well at Michel MICHEL VALBRUN. Go ahead and tap in with me on there to be able to get more game on how to be able to live tax free and build wealth.
This was definitely game, y'all. So honestly, I just want to say thank you guys for tuning in. You guys made it to end, and if you really want to tap in and learn this Airbnb game and also learn how to save some money on taxes, this is also essential information. So go ahead and just tap in with them. And also don't forget to like, comment, share, and subscribe. And I'll see you guys on the next episode. So peace.